Dear friends, we were discussing about types of leverages. In that, in the previous session we discussed about operating leverage. In this session we will discuss about financial leverage. So, first of all, let us understand what is financial leverage. Financial leverage refers to the use of debt to finance assets. Use of debt to finance assets. It increases the potential return on equity, but also increases the risk of loss. In the operating leverage, we have seen that the firm is using operating leverage when fixed cost is used, fixed cost elements is used. That means, examples we have seen: salaries to employees, rent, fixed equipments, investment on fixed equipments, all these are fixed cost means. So, if fixed salary, fixed rent, fixed equipments, all these are incurred, the firm is using operating leverage. Whereas in financial leverage means, if the firm uses borrowed funds or debt sources of funds are used in investment in assets, that means say bank loan, debentures, public deposits, all these are used for investment in business, then we say that the firm is using financial leverage. If financial leverage is used, then there is a potential for increase in return on investment. At the same time, risk also will be high. In the first session we discussed, when we discussed about operating leverage, if more borrowed funds are used, then there is a chance of higher return, but at the same time risk will be high. One example also I mentioned in the first session, hope you are remembering, because instead of equity, if debentures are issued, then interest has to be paid, whether income is there or not, return is there or not, interest has to be paid, interest on debentures has to be paid. Whereas in case of equity shares, instead of borrowed funds, equity shares are issued and money is raised and invested, then payment of dividend is not mandatory. So, that is what the difference in financial leverage and risk aspect. Okay. So, when financial leverage means use of borrowed funds to increase the potential return on investment. So, essentially it means using debt to finance a company's operations or projects with the hope that the returns from the investment will exceed the cost of debt or interest payment. So, you please listen that carefully, with the hope that the returns from the investment will exceed the cost of the debt. So, return from investment means what? Investment in business, and the return what we get, the revenue, the profit what we get from the investment, if it is more than the fixed payment, for example interest payment. Suppose in the beginning I mentioned about an example, we borrowed funds, taken a loan for 10% interest, and if the return from the business, profit or profit after tax from the investment from the business, if the profit after tax from the business, if it is higher than 10%, then the firm is safe That is the meaning. So, that is what is mentioned. It essentially it means using debt to finance a company's operations or projects with the hope that the returns from the investment will exceed the cost of the debt or interest payment. So, if the return from the investment exceeds the cost of investment means the interest on borrowed funds, then financial leverage is using, and the firm is getting more return. That is the meaning. So, the idea behind financial leverage is that by borrowing money, a company can amplify its profits because it does not need to use as much of its own equity to fund investments. However, it also increases the risk because if the return on investment does not exceed the cost of the debt, the company could end up losing. So, quite natural. If the return, we need to pay cost or interest, we need to pay 10% interest, and the return from the business is only 9%. In that case, we need to find out another 1% to be paid as interest. Now, again we will have to take loan for paying the interest. So, it is not good for the company. So, high financial leverage means more debt sources of funds are used for investment in the business. If more debt source of funds are used for investing in business, then there is a fair chance of getting more profit or more return, but at the same time the risk will be high. So, the important points about financial leverage. Leverage ratio, this is a measure of how much debt of a company is using compared to its equity. So, financial leverage means it expresses the relationship between debt and equity. That means how much of debt is used when compared to equity shares or equity capital. So, common ratio include the debt to equity ratio or the debt to asset ratio. High financial leverage means a company has a significant amount of debt relative to its equity. Then, while this can increase potential returns, it also increases financial risk, especially if the company cannot meet its debt obligations. Then, low financial leverage means a company is relying more on its own capital, equity capital, and less on borrowed funds, which might reduce the potential for higher returns, but also lowers financial risk. So, it is in the case of, suppose if you start a business and if you use your own funds alone, then debt is not there, or debt source of funds are very less. There are companies, zero debt companies. Zero debt companies means that they use their own money, or they use equity source of funds only, no debt. So, such kind of companies are not using financial leverage. In such cases, the risk will be very less, low risk, but at the same time the potential to make profit, higher returns will be less. So, when a firm uses high financial leverage, there is potential for the company to earn more profit. At the same time, risk also will be high. If low financial leverage means potential to earn profit will be less, at the same time risk also will be less. So, in simple terms, financial leverage is like using other people's money, that is debt, to try to make a higher return on your investment. But sometimes the things won't go as planned, it can also lead to greater losses if higher debt is used, unless otherwise the investment is regulated or monitored properly, and otherwise there are chances of making loss. Now, as in the case of operating leverage, let us calculate how to calculate financial leverage. Operating leverage, we have seen the formula. Operating leverage is equal to contribution divided by EBIT, contribution divided by EBIT, that is the formula for operating leverage, whereas financial leverage is equal to EBIT divided by EBT is the formula for finding out financial leverage. What is EBIT? We have already seen, earnings before interest and tax, divided by EBT. EBT is nothing but earnings before tax, earnings before tax. See, what is the difference? How to get EBT? How to arrive at EBT? EBIT is nothing but the operating profit. We have seen when we talked about operating leverage, EBIT is calculated as sales minus total cost. We get EBIT, earnings before interest and tax. Then from earnings before interest and tax, we have to pay interest, interest on borrowings. Interest on borrowings has to be paid. So interest on borrowings has to be deducted from earnings before interest and tax. So EBIT, earnings before interest and tax, minus interest paid on borrowings. When we deduct that, we get earnings before tax. Then from earnings before tax, on that amount we have to pay tax. So tax percentage will be given. So on that earnings before tax, tax has to be paid. Then when we deduct tax from earnings before tax, we get earnings after tax, EAT, or PAT, profit after tax or earnings after tax. Then if preference shares are issued, you know that if dividend is paid, first preference should be given for payment of dividend to preference shareholders. So if preference shares are issued by the company, and if the company is paying dividend first, then from EBT preference dividend has to be deducted, less preference dividend, dividend to preference shareholders. When you deduct preference shareholders dividend from earnings before tax, the remaining amount will be the earnings available to equity shareholders, earnings available to equity shareholders, or profit available to equity shareholders. So earnings available to equity shareholders divided by number of equity shares, if you divide with the number of equity shares, you will get EPS, earnings per share. If dividend is not paid, then that entire amount will be used by the company for reinvestment. If dividend is paid, this earnings available to equity shareholders minus equity dividend, then the remaining amount will be retained earnings, the earnings which is retained in the business. Why the firm retains the profit there in the business? It is for reinvestment. For running the business, money is required. It can be used for working capital or it can be used for reinvestment. So that is the reason why a small percentage of the profit only usually firms will distribute in the form of dividend. Balance amount, major chunk of the amount will be retained in the business. Sometimes dividend won't be paid to equity shareholders even though there is huge profit. Equity shareholders will agree for that. Why? Because if the company is in need of money for investment purpose, if money is required, so in such cases companies may not pay dividend at all. So equity shareholders will agree with that, with the expectation of earning more profit in the future, as the money which is retained will be reinvested, and from that investment more profit will be generated in the future. So with that expectation, shareholders will agree for no dividend in some periods. So, that those aspects we will discuss in the next session under dividend policy. So, here anyway so the formula to find out financial leverage is earnings before interest and tax divided by EBT. So, the higher the debt to equity ratio, the higher the financial leverage. That means already we have seen that if debt is more than equity, then the financial leverage will be high. Then formula for degree of financial leverage, percentage change in EPS divided by percentage change in EBIT. Percentage change in EPS divided by percentage change in EBIT. These are the two formulas you should by heart. So, it is very easy. Operating leverage is equal to contribution divided by EBIT. Financial leverage is equal to EBIT divided by EBT. Now, we will discuss about combined leverage. After discussing combined leverage, then one comprehensive problem we will do comprises of operating leverage, financial leverage and combined leverage, and calculations we will do. So, combined leverage is in fact it comprises of both operating leverage and financial leverage. So, combined leverage is the total impact that both operating leverage and financial leverage have on company's profitability. So, combined leverage expresses the impact of both operating leverage and financial leverage on the profitability of a company. So, it measures the overall risk and potential return of a company by considering both its fixed operating cost and its use of debt. So, in combined leverage, the overall return and risk of a company by considering both fixed operating cost as well as use of debt source of funds. So, in combined leverage, we consider the firm's operating leverage or fixed operating cost and the firm's financial leverage or use of debt source of funds. So, in order to break down, you can see operating leverage reflects the degree to which the company's costs are fixed versus variable, which influences its ability to increase profit as sales grows. We discussed in length and width. Financial leverage refers to the use of debt to amplify returns or in some cases losses. So, combined leverage is equal to operating leverage multiplied by financial leverage, operating leverage multiplied by financial leverage, or combined leverage is equal to contribution divided by EBT. It is easy to remember. If you know operating leverage and financial leverage, then combined leverage is equal to multiply operating leverage and financial leverage. So, first you calculate operating leverage, then you calculate financial leverage, then multiply both, you will get combined leverage. Otherwise, the formula direct calculation of combined leverage is contribution divided by EBIT. You know, operating leverage formula contribution divided by EBIT, the denominator is EBIT, whereas in financial leverage the formula is EBIT is nominator, EBIT and divided by EBT. Now, if you combine these two, operating leverage multiplied by financial leverage, operating leverage formula contribution by EBIT multiplied by financial leverage formula EBIT divided by EBT. So, this both the EBITs will get cancelled and final result will be contribution divided by EBIT will be the final formula. So, Please remember this formula, contribution combined leverage is equal to contribution divided by EBT. Okay. Now, high combined leverage means that a company is not only relying heavily on fixed cost, but also using significant amount of debt. So, when we say high combined leverage, that means the firm has high operating cost, high fixed operating cost, and also the firm uses more debt sources of funds. So, this can potentially result in higher profits when sales increases, but it also exposes the company to higher risk if sales declines. So, again low combined leverage means the company has lower fixed cost and less debt, leading to less potential for both large gains and large losses. Now, here one illustration is given. So, in this illustration we will be calculating both operating leverage, financial leverage and combined leverage. We also in this we will calculate return on investment. So, this is a comprehensive problem. This problem illustrates all the three leverages, and also a few other calculations also is there. So, this illustration will definitely help you to understand the concept more effectively. Okay. So, with this we will conclude this session. In the next session we will solve this problem in length. Thank you.